Investors love momentum funds, and the reason is simple. These funds have high returns. However, funds based on alpha strategy have done even better than momentum. So, if you're looking at factors funds, should you choose one based on alpha or momentum strategy? That's what we will discuss in this video. Hello and welcome to ET Money's YouTube channel. Today, we will compare factor funds based on momentum and alpha investing styles. Now, this video is divided into two broad sections. First, we will look at investment strategy of these 11 indices. Here, we will look at similarities and differences between alpha and momentum based indices. Then, we will compare the performance of all the 11 indices. By the end of this video, you will know which one should you pick. So I recommend that you stay till the end. Alright, let's begin. If you want to invest in either momentum or alpha, you need to pick an index fund that tracks one of the 11 indices we will discuss in this video. Now, one of the most popular indices is the Nifty 200 Momentum 30. At present, around 7 index funds are based on this. Although only a few schemes are based on alpha indices, fund houses are launching schemes in this space. For example, Mirae Asset launched Nifty 200 Alpha 30 ETF around 8 months ago. It has now launched a fund of fund for the ETF. The NFO closes on 22nd July. Now, before discussing the performance, we will be discussing similarities and differences in the investment strategy of momentum and alpha index. However, if you're only interested in the performance, you can skip to the second section of the video. Alright, let's start with the first one. So there is no significant difference between the alpha and the momentum indices. In fact, the alpha indices are nothing but a variation of the momentum strategy. To understand why we're saying this, let's first talk about what is momentum investing. Momentum is all about the price movement. So when choosing stocks based on momentum, you primarily look at the 3, 6 or 1 year returns. Price movement is the key here, but on top of it, you can add other elements. For example, you can define the stock universe, choose stocks that are traded in futures and options, and other such parameters. Now, alpha indices are also based on a similar concept. The index makers first look at the recent price movement of stocks. Now, we said alpha is another variation of momentum, as both strategies primarily depend on the price movement of stocks. Now, you might be wondering, what is the difference between these two then? Well, let's talk about that. When constructing momentum indices, the makers first assign each stock a momentum score and then use the free float market cap to decide the allocation to each stock. Simply put, a free float is nothing but stock units available for trading. For instance, let's say company A has 75% promoter shareholding. The remaining 25% holding is with mutual funds and individual investors. The 25% with public is known as the free float. When you look at the total value of these stocks, it's called the free float market cap. Now that's the basic definition. So when you look at the criteria for the all 5 indices based on momentum, they consider the free float market cap along with momentum scores to assign weight. Naturally, the larger the company, the bigger the free float market cap. What this means is that the momentum indices will usually have a higher allocation to bigger companies in its universe. In the case of alpha indices, the makers assign an alpha score to shortlist stocks. And once the stocks are shortlisted, the same alpha score of shortlisted stocks is used to assign weights to the stocks. So, unlike momentum based indices, free float market cap is not a criteria here. However, of the 6 indices based on alpha factor, there is one exception. In the case of Nifty 100 Alpha 30 index, the stock allocation or weight is decided based on the free float market cap. Next, to understand how this criteria affects portfolios of these indices, we looked at the portfolios of Nifty 200 Alpha 30 and Nifty 200 Momentum 30. We took these two indices because both select 30 stocks with strong momentum from the top 200 companies. So, their investment strategy and shortlisted companies are quite similar. However, if we compare the mid-cap allocation in these indices, the alpha-based index had a mid-cap allocation of 5.38% as of June 2024. During the same period, the mid-cap allocation in the Nifty 200 Momentum 30 index was only 0.74%. So, As expected, the momentum-based index is heavily skewed towards larger companies. Now, knowing this difference is essential as it impacts the performance of these indices. For example, we know larger companies fall less whenever the market corrects. So, momentum-based indices may have better downside protection than alpha-based indices. Similarly, in theory, alpha-based indices can outperform momentum-based indices as they are not biased towards large caps. They are more driven by a stock's performance. Now, we will see if these assumptions hold true later in the video when we discuss performance. Alright, the next difference in the investment style of both these factors is their rebalancing frequency. All the 5 momentum-based indices rebalance their portfolios every 6 months. In the case of alpha-based indices, 3 are rebalanced quarterly and the remaining 3 are rebalanced every 6 months. Now, this difference in rebalancing frequency can impact performance. Let's take the example of Alcom to understand this. Alcom entered the Nifty 200 Alpha 30 and Nifty 200 Momentum 30 portfolios in December 2023. However, both indices soon exited it. The Alpha index exited the stock after 3 months, while the Momentum index exited after 6 months. Now, the stock had gained 31% between October 2023 and November 2023. This strong momentum could be why both indices invested in it in December 2023. But the stock lost momentum soon after it was added. It remained flat and generated a return of minus 0.14% between 1st January 2024 and 1st March 2024. Now, due to this underperformance, the Nifty 200 Alpha 30 index exited the stock during its next quarterly rebalancing in March 2024. However, the momentum-based index had to wait 6 months to exit the stock on its next rebalance. So, while the Nifty 200 Alpha 30 sold the underperforming stock sooner, the Nifty 200 Momentum 30 was able to do it much later. Now, this shows how differences in rebalancing can lead to a different performance of these indices. Let's now look at the risks and returns of the strategy indices and how they have performed. Most of these indices were launched recently, so we don't have a long performance history. So we had to rely on the back-tested data for this analysis. Let's first look at the 7-year trailing returns. In the last 7 years, all 11 alpha and momentum indices have outperformed Nifty 500. The top 3 indices had over 25% returns. These include Nifty Alpha 50, Nifty 500 Momentum 50 and Nifty Midcap 150 Momentum 50. The next 2 indices in the top 5 are Nifty 200 Alpha 30 and Nifty 200 Momentum 30. They also have over 22% returns. Now, in the previous section, we saw that both indices have the same investment universe. But here, the returns of the Nifty 200 Alpha 30 were marginally higher than the Nifty 200 Momentum 30. There is another interesting aspect here. None of the top 5 indices were multi-factor. They are either pure momentum or pure alpha. Now, based on the returns data, the multi-factor approach has not done as well as pure alpha or momentum. Let's now look at rolling returns to see if this trend persists. For this, we looked at the 7-year average rolling returns between July 2014 and July 2024. The results were no different. First, all indices have outperformed the Nifty 500 index. Second, the top 5 funds remain the same. Third, the multi-factor indices have underperformed pure momentum and alpha indices. After returns, we will look at the volatility. We will use 2 metrics to measure volatility. First, the standard deviation and then the downside protection. Now, standard deviation is a popular metric to measure the risk or volatility of any investment instrument. A higher volatility leads to a higher standard deviation, which implies more risk. On the contrary, relatively stable instruments have lower standard deviation, which implies less risk. Now, we calculated the standard deviation of the 7-year rolling returns. The results were in line with our expectations. The pure momentum indices that generated the best returns had higher volatility. Multi-factor indices, on the other hand, showed the least volatility. As returns and volatility show a contrasting picture, it's difficult to determine which are the best indices overall. So we combine the returns and volatility. This gives us risk-adjusted returns. For this, we divided the average rolling returns of these indices with their standard deviation. the Nifty Small Cap 250 Momentum Quality 30, which is a multi-factor index, has delivered the best risk-adjusted returns. The pure momentum indices in the top 5 based on average returns were in the middle. And the bottom 3 again were multi-factor indices. These include Nifty Alpha Low Volatility 30, Nifty Alpha Quality Low Volatility 30, and Nifty Alpha Quality Value Low Volatility 30. Now these 3 indices also had the lowest average rolling return. So we dropped these 3 indices from our further analysis and we were left with 8 indices. Let's move to our second volatility metric and look at the downside protection of these indices. For this, we looked at the quarters where Nifty 500 generated a negative return. Now, since January 2013, there were 12 such quarters. Next, we compared the performance of these indices with Nifty 500. We wanted to see in how many quarters these indices fell less than the Nifty 500 index. Now, out of the 8 indices, Nifty 200 Alpha 30 had the best downside protection. It fell less in 8 out of the 12 quarters. The next 4 fell lesser in 7 out of the 12 quarters. However, if we look at the bottom 3 indices, they don't show better downside protection. So, we excluded Nifty Midcap 400 Momentum Quality 100, Nifty 500 Momentum 50, and Nifty Small Cap 250 Momentum Quality 100. And finally, we were left with 5 indices. They are Nifty Alpha 50, Nifty 200 Alpha 30, Nifty 200 Momentum 30, Nifty 100 Alpha 30, and Nifty 150 Momentum 30 Index. These 5 indices not only generated good returns, but also showed decent volatility protection. Now, if we look at the real-time returns of these 5 indices, then in the last 1 year, they have generated very high returns. Nifty Alpha 50 generated 81.61% returns. Similarly, the returns of the other 4 indices were between 68% and 80%. In the same period, returns of Nifty 500 was only 39.4%. So, overall, if you are looking for index funds that can boost returns of your portfolio, these can be some good options you can explore. Now, if we look at investment options for these indices, then for Nifty 200 Alpha 30, Mirai is the only option. As mentioned earlier, the fund house already has an ETF, but currently the fund house has also launched an FO for a fund of fund that will invest in the ETF. Next, there are funds from Edelweiss and Tata if you want to invest in Nifty Midcap 150 Momentum 50. For Nifty 200 Momentum 30, you have 7 options to choose from. In Nifty Alpha 50, you have an ETF from Kotak and an index from Bandhan Mutual Fund. Unfortunately, for Nifty 100 Alpha 30, there are no funds right now. So if you wish to invest in this index, then you'll have to wait until an AMC launches a fund tracking this index. And with this, we have come to the end of the video. I hope you found the analysis insightful. And if you did, please don't forget to share it with your friends and family. I'll see you soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.